You do not have a trading problem. You have a complexity problem. The charts are not failing you. The market is not working against you specifically. The indicators you added in January are not fundamentally broken. What is breaking is the space between what you see and what you do with it. A space that has been filled, over months and years, with conditions and filters and secondary confirmations until the thing you are running is no longer a system. It is a negotiation. And negotiations do not produce consistent execution. They produce consistent hesitation. Trading broke most people who took it seriously not because the market was unreadable, but because the system became unexecutable. Too many rules to follow simultaneously. Too many exceptions built in response to too many individual losses. Too much weight on a framework that should be light enough to run without thinking. Here is what every consistently profitable trader eventually discovers, and what costs most traders years of lost accounts to find. A simple system applied without deviation will always outperform a complex system applied inconsistently. Always. Not because the simple system has a better edge, because the simple system gets executed. And an unexecuted edge produces zero return on every trade it fails to take. This video is not about adding to your system. This video is about returning to what a system actually needs to be. Let me describe the trader most people have become by the time they find this channel. They have tried momentum trading. They have tried reversal patterns. They have tried indicator combinations that required 17 separate conditions to align before entry. And when the 17th condition finally appeared, the entry point had already moved. They have bought courses that taught them new vocabulary without improving their results. They have spent 3 years accumulating knowledge about markets and simultaneously becoming less certain about what to do when they open the chart. They know more than they did when they started. They execute worse. And the gap between what they know and what they actually do in a live session is so large that the knowledge has become its own obstacle. A system is not a promise of winning. It is a promise of consistency. And you cannot keep a promise that requires 30 separate decisions to honor. Let me tell you about Ivan. Ivan spent 3 years in 7 different trading systems trying to find the approach that would make his account grow reliably. He moved from MACD and RSI combinations to Fibonacci retracements, to smart money concept order blocks, to Elliott wave counts, to pure price action, to Wyckoff accumulation and distribution, to a $1,200 paid course system that promised institutional level entries. His average time with each approach before abandoning it was 9 weeks. His reason for abandoning each was always the same. A stretch of losses convinced him the system was not working, and a new approach promised the certainty the last one had failed to deliver. His account across those 3 years told the story with more honesty than any journal entry. He had started with $18,000. His highest point had been $23,400, reached 14 months in. His lowest point had been $11,200, reached after his 5th system change, during a period when he was simultaneously running 2 competing frameworks and following neither with discipline. At the end of 3 years, his account held $18,700. $700 of net growth across 36 months of real work, real risk, and genuine commitment to improving. $700. The audit that changed everything was not a new course or a new indicator. It was a morning Ivan spent going back through 3 years of his own trade records with one specific question. What did the profitable trades have in common? Not what system he was running at the time. What did the actual trades look like? He looked at the entry point on every winning trade across all 7 systems. What he found, and the weight of it took him several days to fully accept, was this. 93% of his profitable trades had 3 things present at entry. Price had been in a consolidation, a base after a prior advance. The entry was at or immediately beyond a level with prior structural significance. And in the sessions immediately before his entry, the price range had been contracting. The market had gone quiet right before it moved. 93%. The system name was different every 9 weeks. The winning trade looked almost identical every time. The spot and enter was already in his history. He had been running it inside every system he tried, and abandoning it every time the surrounding complexity convinced him he was doing something wrong. Over the 8 months after Ivan codified only those elements and committed to running nothing else, his account grew from $18,700 to $31,900. A gain of $13,200 in 8 months, more than 18 times his total gain from the preceding 36 months. His win rate was 54%, close to what it had always been. His profit factor was 2.7. The number of systems he was running was 1. An amateur believes more rules create more certainty. A professional knows that more rules create more opportunities to break them. Here is what the math says about why complexity costs you money. Ivan's 9-week average system tenure meant every 9 weeks he was starting over, relearning entries, recalibrating stops, recounting what qualified and what did not. Across 7 systems, approximately 30% of his total trades were taken during transition periods, after he had mentally abandoned one system, but before he had fully committed to the next. Of those transition period trades, 78% produced losses because they were not system trades. They were emotional trades dressed as system trades, taken from whatever combination of the outgoing and incoming frameworks felt most like a signal in the moment. The spot and enter eliminates the transition period permanently because there is no other system to transition to. Now for the framework itself. 2 phases, 3 conditions for Phase 1, 1 trigger for Phase 2. This is the complete system. Phase 1 is called spot. Its purpose is to identify instruments that are structurally qualified for an entry before any entry decision is made. Not every market, not every day. The qualified ones. The ones where the conditions that have historically preceded significant moves are all simultaneously present. Condition 1. The base. Price has consolidated sideways for a minimum of 4 weeks following a prior advance, a period where the market stopped making progress in either direction, where daily ranges narrowed over time, and where volume declined across the consolidation as the selling pressure exhausted itself. If no consolidation after a prior advance exists, the instrument does not qualify. Move to the next chart. Condition 2. The level. The consolidation is occurring at or immediately below a structural level that has prior significance. A level is significant if price has previously reached it and reversed, the high of the base, a prior resistance zone, a trend line that has been tested at least twice. This level creates a binary directional statement. A close above it is the market choosing direction. A failure to close above it is the market remaining undecided. If no structural level with prior significance exists at the top of the consolidation, the base has no trigger point. Move to the next chart. Condition 3. The coil. At the structural level, price has entered a narrowing range sequence, each session's range smaller than the last, over a minimum of 5 consecutive sessions, with volume declining alongside the range. The current session's range should be at or near the narrowest in 7 or more sessions. This is the energy accumulation stage. Volume declining at a key level means sellers are withdrawing. Range contracting means neither side has conviction. Both sides are waiting for something to shift. One of them is wrong about the direction. The coil is the market's announcement that the shift is imminent. When all 3 conditions are present simultaneously, the instrument moves from watch list to active monitoring. No entry exists yet. Position size is calculated. The stop location is identified. The far boundary of the coil, the lowest price the compression zone reached. The target is identified. The height of the prior advance measured from the breakout level. Everything is ready. The only remaining question is whether Phase 2 fires. Phase 2 is called Enter. It has 1 trigger, not 3. Not a confirmation and a secondary confirmation. 1 trigger, the entry candle. A single bar that satisfies all 3 of the following simultaneously. First, it closes beyond the structural level, A clean close above the base high for a long trade. A clean close below the base low for a short trade. A close means the candle has completed, not an intrabar move, not an approach to the level. A completed candle, settled, beyond the line. Second, the body of the candle, the distance between its open and its close, is at least 1.5 times the average body of the compression candles inside the coil. Body size measures commitment. A large body on the breakout candle means buyers or sellers moved price decisively and held it there through the close. A small body means the move was contested and the close was unconvincing. Third, the volume on the trigger candle is at least 1.5 times the average volume of the compression sessions. Volume measures participation. As covered in the volume professional framework earlier in this series, the effort must be proportional to the result. A breakout candle on low volume is a trap. A breakout candle on high volume is a launch. When the trigger candle closes satisfying all three, enter at the close. Stop at the lowest wick of the compression zone below your entry. Target at the measured move, prior base height projected from the entry level. That is the complete framework. Written out, it fills one side of a note card. Run it before every session. Apply it without deviation. Here is the position sizing math for a qualifying spot and enter trade, so the numbers are clear rather than abstract. A stock built its base between $40 and $50 over 6 weeks, a $10 base. The coil has formed in the final week, with daily ranges shrinking to their narrowest point in 8 sessions. The structural level is $50, the top of the base. The trigger candle closes at $51 on volume 2 times the compression average, with a body twice the average compression body. Entry, $51. Stop, $47, the bottom of the coil, a $4 stop distance. Target, $60, the $50 breakout level plus the $10 base height. Risk on a $25,000 account at 1%, $250. Position size, $250 divided by $4 equals 62 shares. Reward at target, 62 shares multiplied by $9 of profit equals $558. Reward to risk ratio, 2.2 to 1. Respectable. But if that base had been building for 10 weeks, and the coil had tightened the stop to $2 instead of $4, 125 shares, $1,125 of profit at the same target. A 4.5 to 1 reward to risk ratio. Same account, same 1% risk. The quality of the spot conditions directly determines the quality of the enter math. The setup must prove itself before you commit capital. But when it proves itself through all 3 conditions simultaneously, the math rewards you before price moves a single point. Now understand why simple works where complex fails, because the psychology here is not obvious. When you have 15 conditions for an entry, your decision process branches at every condition. At each branch, your brain makes a judgment. Does this qualify or not? Each judgment is contaminated by your emotional state, your recent trading history, your proximity to a profit target, your memory of the last loss. 15 judgments on a single trade means 15 opportunities for emotional contamination to enter the decision. The trade that gets entered after all 15 feels certain because it passed 15 checks, and when it loses, the loss is devastating because certainty was promised and certainty failed. The spot and enter has 4 binary decisions. The base is present or it is not. The level exists or it does not. The coil has formed or it has not. The trigger candle closed with all 3 characteristics or it did not. Binary means there is no deliberation. No, well, the volume is sort of high. No, the body is almost large enough. Present or absent, qualified or not, entry or pass. 4 binary decisions replace 15 judgment calls, and the system becomes executable in conditions where judgment has been compromised, which is every live trading session. An amateur adds conditions after every loss to prevent the next one. A professional knows the next loss cannot be prevented and builds a system that executes clearly regardless. An amateur looks for reasons to enter the trade they want. A professional looks for evidence the setup has already qualified itself. Building one system and staying with it is the most difficult and most rewarding decision a trader can make. The difficulty is that the system will produce losses, perhaps several in a row, and the brain will generate an explanation for each loss that points toward a rule that could have prevented it. That explanation is wrong. That explanation is the anxiety response to uncertainty disguised as analysis. The correct response is not the new rule. The correct response is the next qualifying trade in the same system, executed with the same discipline, at the same size, without modification. Livermore built his fortune on one principle: the line of least resistance, the direction the market was already committed to when the setup qualified, would express itself if he waited for confirmation and entered precisely when confirmation appeared. He did not add filters. He did not seek multiple time frame confirmation. He read the tape and acted when the tape was unambiguous. The spot and enter is that principle made current. Wait for the structure. Wait for the coil. Enter only when the candle is unambiguous. The market is not complex. The system does not need to be either. Spot the condition. Enter the signal. Trust the sample. You spent months, possibly years, looking for the system that would give you certainty. This is the honest answer to that search. Certainty does not exist in markets. What exists is probability. And one clear system, applied consistently to a large enough sample, will express its probability in the account over time, not in every individual trade, but across the body of trades, in the growth that accumulates when the system is trusted rather than abandoned at the first sign of variance. You do not need another system. You need one system that you understand clearly enough to execute without hesitation and trust completely enough to hold without fear. You now have it. Type spot and enter in the comments if you are committing to running this framework this week, not next week, this week. And if you want to build the daily scanning routine that surfaces qualifying setups before the session begins, the morning process professionals run to find the 3 conditions on every instrument they watch. Subscribe now. That is the next video. The system is complete. The process makes it executable. The setup was always there. Now you know exactly what you are looking for. Content JSON for Jesse Livermore. 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 JSON